Investment data that shocked even me, your old buddy Josh. I haven't been this shocked since I found out that Joe Biden was the most popular president in history. In fact, that Joe Biden was more popular among black voters than Obama was. I haven't been that shocked, this shocked since then, because obviously that Joe Biden being more popular than Obama or Kamala, that checks out. Among blacks, checks out. Anyway, check this out. This is from Drawdowns and Recoveries, dateline May 21st, 2025. We talked about this in last night's live stream. If you're not part of the live stream, you're missing out. We do it every Saturday at 7 on YouTube, 7 p.m. Eastern time, and we do it every Wednesday at 7 p.m. On Locals channel, my Locals channel, which you can find more in the doobly-doo down below. So sign up and join, or else you're a loser, all right? Check this out. We're going to look at this guy, Henrik Bessembinder. Now, I've talked about this guy before. It's been a while, though, from ASU. He studied roughly 28,600 public companies that have been listed in the United States from 1926 and 1920 to 2024. All right. His definition of wealth creation, i.e., did the stock create wealth or not, is that have produced returns in excess of the 1-month Treasury bill. All right. So if you can't return returns in excess of 1 month Treasury bill, you are a loser. That's just a fact, because the 1 month Treasury bill is the most risk-free investment in L world. All right. Literally, you cannot have a more risk-free asset than a 1 month Treasury bill. And so if you're in a stock and you can't do it, that's the wrong answer. So what Bessembinder found was just under 60% of these 28,600 public companies failed to match the return of the 1 month Treasury bill. The other 40% created $89 trillion in wealth. But just 2% of the companies created 90% of the aggregate wealth creation. So just 2% of the companies gave us 90% of the increase in stocks above the 1 month Treasury bond. And the top 6 added about 15% of that. ExxonMobil and the rest are the tech stocks. Are you hearing me? Just 2% of the companies of the entire publicly traded market from 1924 to 2024 added 90% of the growth in stock. So if you miss those 2%, you're SOL. And they give some examples of Amazon and whatnot. If you've Amazon created an exorbitant amount of wealth, but even Amazon had a 95% decline from December 1999 to October 2001. Interesting. And we talked about that before, but here's what I want to talk about now. The max, these guys are looking at 6,500 stocks from 1985 to 2024, and they find the median, 50% had more, 50% had less, had a maximum drawdown at 85.4%. That's insane to me. From 1985 to 2024, the median stock had a maximum drawdown from top to bottom of 85%. That means you started with $100. It was down to $15, the median. It took 2.5 years from top to bottom, all right? And then 89.6% was the recovery. What does that mean? The median stock only recovered 90% of its top. If it went to 100 to 15, an 85% drawdown, it only got back to 90. And even then, it still took 2.5 years to get back to 90. So we got 2.5 maximum drawdown, top to bottom, 2.5 to get back to par for the companies that even did. But yet, 90% was where the median stock went. It didn't even get back to par. Isn't that crazy? The median time to go from trough, to par was 2.5 years. The same it took to go from peak to trough. And again, that's assuming that the company actually went back to the par value, which is the highest it was. And only 89.6% is the median returned. It didn't even get back. The median didn't even get back to the high value. Is that crazy? Here's where it gets crazy. If your maximum drawdown right here was 80 to 100% was your maximum drawdown, less than half of those stocks actually got back to par. So again, we start with $100. If our maximum drawdown was we went from 100 to 20 or below, less than half those stocks actually ever got back to 100. Now, this is just price, it's not including dividends, but in these low dividend years, it's not going to be a huge difference. That's insane, man. I never knew this. This is crazy. Now, again, from 1985 to 2024, so it's recent history, I grant you, but still. If you had a maximum drawdown of 80% or more, you went from 100 to 20 or less, only less than half those stocks actually got back to even Steven. In fact, if you're a 95 to 100% drawdown, only 16% got back to even Steven. 90 to 95% was 37%. I mean, it's crazy to me. And you can see all the number of stocks right here. Of the 6,500, 1842 had drawdowns of 95 to 100. 830, 678, 584 had drawdowns of 80% or more. If I take my trusty calculator, that's 3,900 of the 6,500 stocks had drawdowns of 80% or more, which is 60% of them. Crazy, dude. Crazy. And yet, remember, of those 60% of those stocks, less than half got back to even Steven. And yet, if you had a max drawdown between 0 and 50%, you could go as low as $50 on a $100 share price. It only took 1 year from top to bottom. And it took 1.5 years to get back to par, and yet 80% of those companies did get back to par. The problem is only 455 stocks actually did that of the 6,500. The data revealed that the further a stock falls from its peak, the lower its probability of ever attaining that past apex. Only about 1 in 6 stocks that decline 95 to 100% ever get back to their prior peak, while 4 in 5 who would draw back less than 50%, draw down less than 50% do so. And he gives an example here. For example, assume a stock peaked at $100 and draws down 77%. So now he's trading at $22.50. If the stock recovers to the median of the cohort, 122% of the par, the stock would be up 5.4 times. All right, so again, we're only going, in this case, the median of the cohort. If the stock was up 22% above where he were, 100. So again, we went from 100 down to 22.5. It got a rip. If it goes to the median, 122, so just 22% of where he started off, it'd have to be up 5.4 times. A stock that peaks at 100 and draws down 97.5% would go to 2.5. And a bounce to 16% would still be a 6.5 times increase. So what he's saying here, these guys are saying is, a stock that goes from 100 to 90 and draws down 97.5 is at 2.5. It would be up 6.4 times off the bottom. You'd get a 6.4 times rate of return, a 640%, but yet you still only be at 16% of where you started. On the other hand, a stock that went down from 100 to 22.5, it would be up right here. We show you right here. I think it's 5.4 if memory serves. 5.4, 540% of the time, and you'd be up 22% above where you started. One is 22% above where you started. The other is 16% still of par value. But one was 640% higher from the bottom, and one was 540% higher from the bottom. So you can make money buying low-cost stocks, you think, but you can't ride those down. And again, we got a V pattern here with a sharp decline at the bottom followed by a strong price recovery. The portfolio of the value of the stocks fails to reach the peak established 2 years before the bottom. 5 years after hitting rock bottom, the price of the portfolio is still only 80% of what it was 2 years before the top. The smallest maximum drawdown, quintile, follows a similar form, but it's markedly less dramatic in its fall and rise. Interesting. The vast majority of these stocks fully recover and manage solid gains following their lows. So what do we take from this? It's pretty simple. You always sell, you cut your losses and ride your winners. Because you're going to be going from 100. You don't know you're going to be bottoming out at 250. You don't know that. And we showed you a significant proportion of stocks do have that massive drawdown. You just don't know. I just showed you 60% of stocks from 1984 to 2024 had drawdowns of 80%. And the vast majority of them never got back to the even Steven at all. Now, that doesn't mean you can't make money on the bottom. The question is, what's the bottom? What's the bottom? Is the bottom 2.5 or the bottom 22.5? And you don't know. So the issue is you don't buy more shares on a falling market. on a falling stock. You don't. I mean, you can do whatever you want, but I'm just saying at the end of the day, the numbers are the numbers. You say, I bought it at 100, it's gone down to 50, I'm going to buy some more. I'm going to dollar cost average downwards. Now it's at 25, I'm going to buy some more. Now it's at 10, I'm going to buy some more. So you've dollar cost average downwards, and that sounds good in theory, except that $100 share price is going to you're never going to regain that. The $50 share price you might, but you're going to this is always going to be the albatross around your neck. Now, the one you bought at 10, yeah, you probably make some money, but is it going to offset the amount of the decline from 100 to 10, a 90% decline? The answer is no. Cut your losses, ride your winners, man. And that's just all you got to do. And so what I do is I say, hey, man, look, again, this is not telling you how to buy and sell stocks. But if my losses are 20% or more, I'm cutting them. 100%, cutting them. Because the likelihood of that coming back to even Steven isn't very high, but the likelihood it keeps going down is quite high. There is something called trends and momentum. Trends and momentum go both directions. Trends and momentums go down, and they go up as well. You never want to buy in the bottom because you never will, but you always want to buy when it jumps. You always want to buy not at the bottom because you never will. You wait till it bottoms out, and you buy when it starts rising again. But you never want to sell, you never want to hold on something, hey, I'm just going to get my money back, because we just showed you the vast majority of times you don't come close to getting your money back. Anyway, that was shocking to me. I followed this guy for a long time. I used to be a broker at Legg Mason in the 90s or the 2000s. This guy used to be our investment analysis guy, chief financial officer, whatever it is. And I think Legg Mason is now part of Morgan Stanley, so this is a Morgan Stanley piece. So there you go. That's your shocking investment news for the day. Love your thoughts, and tickle and fondle that like button. We'll see you.